Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Hey, Dad, do you know the golden rule?
Yeah, Jesus said, do unto others as you would have them do unto you.
That might be in the Bible, but I'm talking about the investing golden rule.
Oh, what's that?
Those who have the gold make the rules.
Aha. Yeah, I hear you on that one. And it's kind of crazy, right? Because gold today is in a similar price range as it was, 10 years ago or more. And how many times over the past 15 years have people said, Andrew, I want to buy gold in my retirement portfolio, or should I buy gold or that kind? Let's talk about that today. Does gold belong in your retirement portfolio? I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. AAA, I think this is a great topic to talk about because you're right. Since 2011, gold is the same place as it was in 2011. And we've had lots of people say, hey, should I buy gold? Should I put my full portfolio in gold? Should I cash out my IRAs, my 401ks and buy gold? And people listening right now might laugh at that, but that's a serious thing that people have said.
That's
Is
right.
should I cash out my whole IRA or my whole 401k and buy gold?
Right. And there's issues, there's problems with that, right? Because a lot. And some of the things when there's two reasons people buy gold or want gold. One is for the security because the end times and everything falling apart. Another is to be able to add to their portfolio and get growth out of it. But how do you get growth out of it when it's been the same price for the past 10, 12 years or whatever? So it's a perspective you got to take look at. And if you're talking about protecting against the end times and that kind of thing, is kind of crazy because during the Depression they confiscated gold, and today the only way that you can you can't have gold in an IRA because for that purposes, because if you do, it's got to be somebody's got to be a custodian of it, generally speaking, and if something happens, you're not going to be able to get to it, and then it's in the banks, and if they close the banks, so that the only way that if you're going to have gold for safeguarding purposes, you got to have physical gold, and you got to store it someplace where you can know where it is and protect it and that kind of thing. So that's not so much what we're talking about, because that's not so much retirement portfolio as that's just a safeguard method. We're talking about, should we have gold in your retirement portfolio? So your IRA or your savings for retirement, your investments, right, Daniel? That's what we're looking at today.
Yeah, exactly. And let's go over some different ways of holding it. But before we do that, let's break down for listeners some of the reasons we've come up with that people would like to hold, or that people say, hey, this is a reason that I want gold in my portfolio. And the first one is portfolio protection, right? It has the potential of decreasing volatility in a portfolio. You talked about some of the ones that we're not talking about because we're not talking about like end of world scenarios.
Right.
Another one would be protecting against a policy error. Right. And we'll dive into these, but I just want to lay this out so listeners know what to expect. The growth potential that it can provide. It can work very well as a store of value.
Right.
And the diversification benefits that it can provide. So these are some of the things we'd like to get into today on our show, and go from there.
Yeah, sounds great. Let's dig in. Portfolio protection.
Yeah. First, let's talk about some ways of holding gold, right? Because we want to be on the same page. So one way is physical, like you mentioned. Another is you could buy something like GLD, right?
Which is crazy.
Which is crazy, and people may not know this. GLD is a trading investment. It's if you want exposure to gold price. But if you think you're protecting your portfolio by buying GLD, it's not, because it's completely manipulated market where they don't, okay? So the custodians don't have enough gold to back all the gold in the ETF.
Right.
And so if you needed that gold or you wanted that gold, there wouldn't be enough. And inside the prospectus, it says they don't have to settle with you in gold. So you won't get your gold if you ever needed it for the gold. So if you're using GLD, make sure you know that and you're just using it for trading purposes, not investment or protection purposes.
Right. Only buying paper is what you're doing. You're not buying gold. You're just buying paper that's got gold written on it, basically, right?
Right. Right.
All right. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, does gold belong in your retirement portfolio? And we've got some good things coming up for you. But before we get into that, and we want to give you an opportunity to be able to take advantage of a commissioned report that we put together for you today. Just a couple page report, understanding price to earnings ratio. When you look at the stock market and if you understand price and earning ratios, you understand that the valuations in the stock market right now are crazy. So you need to be able to diversify and you need to be able to invest in other ways. And that's why we're talking about, does gold belong in your retirement portfolio? So this is a paper that will help you. It's just a 2-page report, understanding price to earning ratios, to be able to understand where things stand in the stock market so that you can protect yourself. Call and ask for it by name. Price and earnings ratios, PE ratios, 800-725-7616 for your free copy. 800-725-7616. Today's topic, does gold belong in your retirement portfolio? Daniel, so holding gold physically, holding the paper, right? If you buy GLD, the ETF for gold, which is not really gold, it's just buy and sell, trading it, front kind of thing. What else?
And then there's some proxies for gold, like you could buy miners, gold miners. There's some things that have
And
exposure
is
to
gold
gold.
miners, is that actually, mines, places that mine gold? Is that what you're talking about when
Correct.
you say gold miners?
Correct.
Okay.
Yeah. Yeah. Um, like Newmont Mining. There's a few different mining companies, large mining companies. And now
Okay.
again, these pay a dividend, but these kind of haven't done anything because the gold price hasn't done anything. And they're
Okay.
difficult to use that as inflation hedge. People say they'll be inflation hedge, but the difficulty with these is that when inflation goes up, gold prices might go up or silver prices or precious metals, but dump trucks go up and fuel goes up and labor goes up. So even though they're getting more income, their expenses go up too. And these have not really been a great inflation hedge or
Way to
growth.
invest your money, right? Yeah.
Yeah, for the past few years. Now some people would say, well, if gold goes up, they'll go up, and they will. And you can look at the big miners, you can look at the junior miners, you can do certain things like that. But these don't necessarily lower the volatility, because that's the first thing we're going to talk about. Portfolio protection, right? Another thing you can do is you can buy ETFs or trusts that own physical gold that actually hold. It's called allocated gold. That means when you buy the ETF, they take the gold and they put your name on it in a vault. And these can work well for decreasing the volatility in your portfolio. So typically, gold has been non correlated to stocks. And so a lot of times, when stocks go down, gold can go up or gold will stay flat. And then it gives you optionality. We talk all the time about optionality in a portfolio. We love optionality because it allows you to take advantage when things don't make sense. We go treasure hunting, right? We're
Right.
always treasure hunting, but there's a lot more treasures to be found when things don't make sense.
Right.
And you want to capitalize on that while they're available. But if everything in your portfolio is down, how are you going to capitalize it? And
Right.
if you have a cash cushion so you can live off of and everything's down, you don't want to spend your cash cushion, because if it goes down further, what's going to happen?
Right.
You're not going to have cash to live. And that's something we see people run into, these issues with kind of traditional investing in ETFs and mutual funds and stuff like that, is everything's kind of correlated.
Right. Okay. And all right, good. Well, a lot of so there's they can invest in ETFs, they can invest in um, uh, proxies with gold miners and these different kinds of things that can uh, create potential for growth and hedge against policy error and a lot of other things. So you're listening to Financial Strategies with Andrew and Daniel Agemy. Does gold belong in your retirement portfolio? Is our topic for today. We'd love to give you a book before we take a break here. This book is called The Richest Man in Babylon. And we love to be able to educate you with this because people don't know what people don't know. And educated retiree is a happy and stress-free retiree. And this book will be able to give you some perspective, easy read book on what back in Babylonian days, thousands of years ago, what people did to become rich and to be able to maintain their wealth. And this will give you some perspective and enjoyable at the same time. Call for it, ask for it by name, Richest Man in Babylon, 800-725-7616 to the next 5 callers. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
AAA, if let's do a thought experiment. If I came to you when you were 18 years old and said to you, Andrew, you seem like a pretty solid guy. You seem like you're going to do well. What I would like to do is I would like to invest in your life, and all I want in return is 1% of your future earnings. This is all assets. I'll just get 1%. And what I will do is I will fund your entire education. You won't have a dollar. I'll take care of housing, everything for you. And all I want in return is 1%. In hindsight, you've already gone through college. You know how much that costs. And you're doing well in business. Would I have made money on that deal, or would I be losing money on that deal?
You would have made a ton of money.
This is an example I like to use to kind of explain one of these investments we're about to talk about, royalty and streaming companies. I'm Daniel Agemy.
And I'm Andrew Agemy, and you're listening to Financial Strategies with Andrew Daniel Agemy. Today's topic is, does gold belong in my or in your retirement portfolio? And as we're talking about, people don't know what people don't know. So a question is always coming up in regard to gold and where that belongs and should I buy it, whatnot. Daniel, streaming companies, that intrigues me. I know what streaming companies are, but I want you to your little experiment there, thought experiment and whatnot, is a great thing. And the fact that is this available? So what I hear you saying is like this thing, what you just described, is available to our clients.
Yeah, these royalty and streaming companies may be the best business model ever invented. And it's kind of like what we talked about. There's a company that goes and they can do it on all kinds of stuff, pharmaceutical patents,
Wow.
gold, copper, battery metals, all kinds of stuff, land, water rights. And what they do is they provide money to these companies. So let's say it was a company that wanted to expand their mining operations. They mine gold and they want to expand their mining operations. They need $100 million. This company provides them with $100 million, and then they get to collect whatever that agreed upon. It might be 1%, it might be 2%, and they get to collect 2% of that mine's future income.
Wow.
Now, what can happen is, we talked about how gold has not done anything since 2011.
Mm-hmm.
It's the same price. Miners haven't done much at all either. But these royalty and streaming companies are up multiples.
Wow.
These companies have done phenomenal. And the reason is because they don't have the inflationary problems that a miner has. They don't have to buy dump trucks. They don't have to buy fuel. They have a one-time investment. And just like I invested in your education, and they
Right.
get a stream. The companies do all the work. All they have to do is the due diligence on the right mines
Wow.
and then collect an income. Now they can increase that income multiple ways by the price going up. So if gold prices go up, their income stream goes up.
Right.
If the mine expands and gets bigger and produces more income, their income goes up, right? And these are a really, really interesting and cool way of having exposure to gold. Now, the other thing is it's kind of a leveraged play on gold. So when gold goes up, it will go up more than the gold price.
Right.
And so these are one of the best inflation hedges. Dividends are probably the best and most certain. These are pretty good right there with them as far as having exposure to the benefits of inflation without having what usually happens when a company there's inflation. Well, labor goes up, right? Well, these companies barely have any employees. If we look at a chart of like the most profitable companies per employee, you see companies like Facebook up there, where I think it's like $500,000 per employer.
Wow.
Franco Nevada, one of these royal companies, it's something like $800 million
Ah,
per employee.
wow. Talk about profitability, right? And then that equates to people that own that. That's great. If you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is: does gold belong in your retirement portfolio? Going along with this, why? The bottom line is, yeah, we think that it could have a place in people's retirement portfolios if they do it properly. And one of the ways that you can understand this and why to do this is by understanding the price and earnings ratios of and how they work in the stock market, PE ratios of the stock market. They're kind of going through the roof. And so you need to be able to invest in a different manner to be able to make money with in retirement portfolios today. So we'd love to be able to put a commission report in your hand that will help explain this a little bit more accurately than what I just did. And it's just a 2-page paper, understanding PE ratios. Ask for it by name. PE ratios. Call 800-725-7616 for your free copy. 800-725-7616. You're listening to Financial Strategies because people don't know what people don't know. Daniel, what don't people know about using gold in their retirement portfolio and why that might be beneficial to them?
So there's like two big ways. There's many, many ways to lose money, right? But there's two big ways to lose money. The first one is what most people think about: risk, volatility, right? I bought Tesla stock at $200 a share, and today it's $100 a share, right? I bought S&P, and now I'm down 25%. People don't like that, right? People do not like volatility. So market risk, some people might remember investing in, let's say, Cisco, the technology company, or Intel, the technology company, right?
1999, right?
In 1999. And these are wonderful, wonderful companies. They make a lot of money.
Yeah.
And most people probably don't realize these companies have not reached their highs from 1999.
Ouch.
So good companies do not necessarily equate to good returns. You can pay too much.
Mm-hmm.
And there's some stocks in the stock market right now that seem an awful like those companies, where people don't think there's too high of a price to pay. And when we're talking about investing, we're talking about everything's relative. So you only have so much capital. So you have to choose what's going to give you the best risk adjusted return, the best return on your money, right?
Right.
So that's one way.
Yeah.
of losing money. And that's why you're given that paper way that explains PEs and how you can kind of tell if a company's expensive or if it's not so expensive.
Right.
That's one way of measuring that. Okay. The other way you can lose money is by debasement of money.
And both of these ways sounded to me like a game of musical chairs, right? Where music stops, you're left without a chair and left without some money. So that debasement of money, let's talk about that some more.
So the first one, it's obvious when it happens,
Right?
right? People don't like it because they feel it and it hurts them.
Right.
Your account went down 20%. You had $1 million, now you have 800. People don't like that. Goes down to 700. People really don't like that. It goes down to 6, and people get angry, right?
Right.
The second, it's slow and people don't notice it. It's a way that governments for all of time have stolen from their people.
Right.
Because the people don't notice it. It happens slow and gradually over time. It was from the olden days when they used to have coins and they'd shave off the corners of the coins. That was a way of debasement back then. Or they'd collect taxes and have the gold come in, and then they'd redo the coins. They'd remelt the coins, but they'd mix other metals in there that wasn't gold. That's where the term debasement came from. And so when we look at this creates asset inflation. So if we look at housing or we look at vehicles, right? Look at how much vehicles have gone up. Look at how much housing has gone up. It's not because there's more people wanting to buy houses. It's not because there's more people wanting to buy cars. It's because the thing you're measuring it has gone down. So the dollar has gone down. And so this is another way of losing money. Right? This is another way of capital destruction. And you have to at least keep up with that.
Yeah, but that's what's happening, right? Houses are going up, and so they're worth more. So, you're in good shape, right?
Yeah, housing's one of the funniest things because when most people actually do the math on what they earned on their houses, even people who, their houses have doubled and tripled, and it feels like a lot of money because it's a big dollar amount. Right. And they actually go back and they look at what they paid in taxes, and they looked at what they paid in interest on the mortgage, and they looked at all the repairs that they've done, and then they average the time that they've owned the house. It's really not that great of a return.
Right.
And if we look at the stock market and people say how much if we invert the S&P 500 to the Fed's balance sheet, it's flat. It's basically just kept the same purchasing power. So how do investors stay ahead of that? Like, how do investors not just keep the same purchasing power, but how do they actually get ahead and actually earn above what governments are creating, but at the same time, not lose money on asset depreciation because your account went from $1 million down $700,000?
Well, it's time for us to take a break. And before we go to break, you listen to Financial Strategies. Andrew and Daniel Agemy. Today's topic: does gold belong in your retirement portfolio? We'll have to give you a book because educated retiree is a happy and stress-free retiree. This book's called The Richest Man in Babylon. And it gives some very basic principles that might be very basic to you, but in the meantime, it's entertaining and educational to be able to help you understand. You don't give your money to a blacksmith to go buy diamonds. And so we'd love to be able to put this book in your hand to the next 5 callers at 800-725-7616, 800-725-7616. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
This inflation stuff is crazy. I get so frustrated with this inflation at times. The other day, I went into a fast food restaurant and asked them for my order, and they put it on the counter there. And when I put my credit card in, it says, you want to give a 15% tip, a 20% tip, or a 25% tip, which I think is just egregious because why am I giving a tip when they're just doing their job? And it's, to me, it's inflation upon inflation, because you got the price of the food going up, and then you got the pricing of the tip going up, and it's egregious. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about, does gold belong in your retirement portfolio? AAA, that's an interesting thing because we use money all the time. But what is money? People like having that little green paper in their pocket or swiping a credit card and being able to pay stuff. But do we actually think, what is money? Why do we want money? What is it backed by? Some people still think that money is backed by gold.
Right.
It's not. And 1971, Nixon removed the dollar from the gold standard.
Right.
And since then, we've had insane asset inflation. We've had insane price inflation. And I think that's what you're talking about, is price inflation of things like food. And that's the theft we were talking about earlier.
Right. Debasement.
Well,
Right.
theft, right?
Right.
It's
Right.
theft.
Right.
You trade your time. This is such an egregious thing. People trade their time for money, and then countries, governments, and corporations steal that from them by debasing it, right? So governments do it by creating more money. Corporations do it by creating more stock. If you own stock in a company, you think you own that much of the company, but they can go and they can issue more shares. Now, you hope that it's going to do good for the company, or you'll get more earnings in the future. But this is another uncertainty with these kinds of things. So gold cannot be debased, right?
Right.
Gold increases about 2% every year. There's about 2% increase in the gold supply because that's what miners find.
Oh, okay.
And that's about the right amount that there should be. And that's why gold has worked so well for so long. But just like we talked about in ancient times when they debased gold currencies, or their currency that was gold, they find new clever ways to debase currencies now, like creating money. And we've seen this more and more, right? For example, the pandemic, they created, what was it, about $10 trillion?
Terrible.
So that's debasing the existing money. So this is what gold does really good at, is it protects us from policy mistakes, right?
Right.
There's a lot of debt problems. There's a lot of issues with covering the country's debt. And a way that you can protect your portfolio from this is by purchasing gold or things like gold, right?
Right. Right.
Bitcoin is another one that works the same, where it's a mathematical certainty that it will go up because of the way our current system works. So because the supply is set, it's mathematically set, it's software, it's code, and it can't be changed without all participants' approval.
Right.
We know that as there's more and more dollars, Bitcoin will go up in value, not because it's going up in value, but because what you're measuring it is going down in value.
Yeah.
So there's a few different ways people can look at this and can use these types of things, like the streaming companies, which is exposure to gold, but it's more of leveraged. So if there was a policy error, it wouldn't just go up like gold does. It would go up far above what gold does because it's a leveraged play on that. So you don't need a lot of it in your portfolio, is the whole point, to protect you from policy error. Gold makes your portfolio nice and stable. It may not do more than inflation, but it doesn't matter what time frame you look at. Gold is basically the same price. If you buy a fine suit in any time period, it basically costs the same amount in gold, no matter what time period. The dollars, whatever you're measuring it, because dollars haven't been around forever, changes, but it costs the same amount in gold no matter what time frame you're in. So that's a nice stabilizer to a portfolio.
Okay. So
Some of these other things actually will give you protection against policy error, or give you protection, or give you leverage, I should say, where you don't need as much of it in the portfolio to protect you from some of these long tail events.
okay, so like a streaming company, it can exponentially, when gold goes up, one time or 10 times, whatever it is, the streaming company may go up multiple times, 10, 20, 30 times, and exponentially expand. That's one way to invest in gold. But the main thing is that gold is a store of value. Like you said, keeping, a suit, a well-made suit, whether you go back to the 1800s or you do it today, or, 50, 70 years ago, a suit costs the same in gold at any one point in time. So it's a store of value. That's a reason to have it in somebody's retirement portfolio. Well, we're talking today on financial strategies with Andrew Daniel Agemy, but does gold belong in your retirement portfolio? And in order to go along with today's show, we have a paper that we put together. It's a 3-page paper called The Importance of Financial Defense. Gold can be a defensive play, like Daniel was just talking about, being a hedge against policy error and some other things that is happening, as well as a hedge of inflation, but importance of financial defense. And we love to be able to put this paper in your hand, but call it by name, Financial Defense. Call 800-725-7616 for your free copy. 800-725-7616 for your free copy of Financial Defense. Today's topic is, does gold belong in your retirement portfolio? Daniel, gold is able to protect against inflation. Gold is able to help us with hedging against policy error. This, it's a store of value. We get growth out of gold. All kinds of different things are a piece of why gold should potentially be in somebody's portfolio. We're not recommending, we're not saying, oh, everybody needs to have this, but this is what our perspective is when we're looking at people's portfolios, of why that might happen. And I like what you're talking about earlier about Bitcoin being in, whether, a piece of that. Now, some people may not like Bitcoin, so that's where gold is. But some people might like gold and they might like Bitcoin for the same reason they like gold. Correct?
Yeah, exactly. These things. So gold physical gold is not really an investment as much as it's money, right?
Okay.
JP Morgan said gold is money, everything else is credit, right? You think about the dollar. It's an IOU, right? The Federal Reserve says that that's worth something, and so we say it's worth something. But what's it worth, right? So gold is money. So if you want, that's the safest version, is you own gold in a safe, but it's not an investment. And then you can move up, right? You could go to something like ETF, right? That owns physical gold, so you don't have to do it. It won't get robbed. It won't get stolen.
Right.
You own that in your brokerage account, and it can add stability to your portfolio. Then you can move up to the next thing. If you actually want more protection, leverage on that. So if there's a policy mistake, if there's tons of money printing, that you can exponentially benefit from it, then you would go to something like the miners. But miners they've destroyed investors' capitals for years. So that's a hard one. You got to really know what you're doing if you do that. That's a hard one to do because they've been really good destroyers of capital. Then you could go to royalty and streaming companies, and these have even better leverage on the gold price. So they will do things. They may not protect you from volatility because they can be very volatile. But in a diversified portfolio, what they can do is they tend to be non-correlated. So they can go up when other things are going down, which gives you more optionality. And then in the case of policy errors, right, money printing, bailouts, these kinds of things, they have leverage on the gold price, so they can make you a lot of money, protect your entire portfolio from debasement.
Wow.
And then if you were to go one notch higher, for those people who can understand how Bitcoin works, that's another thing that could be in the portfolio that would be even more exponential. So when I say exponential, I talk about liquidity, right?
Right.
Liquidity, what's driven the markets for the last 10, 12 years? Liquidity, right? New money coming into the system, us doing quantitative easing, creating money, right? Company buybacks, right? This is what's driven the markets. And so you want something in the portfolio that you don't need a lot of, because these things can be volatile, and you don't want your portfolio, your retirement portfolio, to be volatile. So you don't want a huge portion, but you want something that can really benefit from liquidity and money printing and policy errors, right?
Yeah.
And so the things that we've really thought are good things, depends on each person individually. Like you said, this is not a recommendation, is to have small portions to either Bitcoin
Yeah.
or these royalty and streaming companies, diversified through some royalty and streaming companies, or if you are the most conservative, gold, right? And not
Yeah.
through GLD, but through some of these things that old allocated gold.
Well, there's a lot involved. It's not, it's not easy peasy. Hey, Daniel, will you be my investment guy? I want to have my money invested like this. You're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is, does gold belong in your retirement portfolio? We're going through talking about the different avenues, and it's not, there's a multitude of ways to invest in gold. But before we take a break here, we'd love to be able to give you the opportunity to read and educate yourself further than what our show is today. That's called The Richest Man in Babylon, is the book we have today. Love to put this in your hand for free to the next 5 callers at 800-725-7616. And we love to put this in your hand so that you can educate yourself. Easy read, fun read, to be able to understand a little bit more the basics and the expansiveness of being able to understand how to invest properly and how to invest in gold and other things for your purposes. And we love, as I said, call 800-725-7616 to the next 5 callers. Call now.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
Daniel, I was so happy the other day. Jim and Michelle came in for a review, and as I was going through, I said, Jim, Michelle, your $2 million that you have in this portfolio of yours is up 20% this year from what it was last year. Your $2 million is producing $140,000 a year of income for you. Are you ready to retire? Because it's ready for you to retire. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about, does gold belong in your portfolio? And AAA, what does gold that doesn't pay any dividend have to do with increasing one of your clients' income portfolio?
Well, that's exactly it. It's a beautiful thing, because what gold doesn't necessarily do a lot, but when you're invested properly and you get the exponential increases on it when the policy changes happen and things happen, when gold does go up, we're able to take advantage of that, selling high and buying dividend producing investments that will expand people's retirement income. It allows them to keep their portfolio in place without losing money. And ultimately, at the end of the day, helps them to be able to have more than enough income to live the rest of their life.
Yeah, so we've really focused on 2 different ways of participating in gold prices. One is to own a gold-backed ETF or ETP where there's allocated gold that has your name on it. And since 2011, gold is flat. So there's no dividend. There is no really increase in value. You could trade around, but what that does for people is that lowers volatility. You don't need to make money to make money. How does that work? Well, if everything else in your portfolio went down, but the gold stayed the same,
Right.
then you have the options to do certain things.
Mhm.
You can sell part of that and buy good deals, you see, which is an amazing feature of it.
Right.
You can do a little bit more strategic planning where you predict the future, right? So 2008, markets fell apart.
Right.
Gold didn't reach its high though until 2011 because people kept thinking the world's falling apart, the world's falling apart, and going into safe assets, right?
Right. Right.
Then the stock market took off, gold came down, and it's back where it was today.
Mhm.
So if you're owning gold in your portfolio, you kind of either want it there so you can sleep at night, or you kind of need to trade around a little bit in it.
Right.
You either understand it's just something there to keep the volatility low, or you're using it so that you can take advantages of other things going on. The other thing we talked about is kind of these royalty and streaming companies, right?
Right. And that's what.
And
Go ahead.
what's that?
I was
And
just going to say.
these have actually earned money. They've earned a lot of money since 2011. Okay.
Nice.
Gold's flat, but they're up. How is that even possible? Because it's a type of income, just like the income portfolios we're always talking about. Okay. These royalty and streaming companies are collecting income streams. They have multiple income streams around the world. So, like in our example, where I asked you if I paid for your education, but I
Right.
got 1% of your income, would I make money? Well, now imagine doing that for 50, 60, 70, 80, 200 people.
Yeah.
Because you're going to get some duds, but
Right.
hopefully you're good enough judge of character. Most of those are good. That's a lot of income. And then do you know what they do with that income? They go pay for more people's education and get more income streams for the future. And it's just this compounding machine. So these could move 100%. We've had them move 100% up.
Sweet.
And a thing that you can do, it moves up 100%, moves up 150%. You trim it back down to the size that you want. And what does that allow you to do? Well, in $1 million portfolio, if that was 2% of your portfolio, it goes up to 4% of your portfolio.
Yeah.
You sell it back down to 2% of your portfolio. You just generated $20,000. Now, if you invest that into something that produces income, and the cool thing is these are usually going up when other things are going down. Example, we had all these bank failures. These things are going up, 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 while there's all kinds of mispriced securities. So you can sell that down while it's high, invest in more income producing assets, right? Now you buy $20,000 corporate bond, and maybe that's paying $1,200 a year. You just increased your retirement portfolio by $1,200 a year of real money you can spend. And then when these goes down, because it's not a big portion of your portfolio, it doesn't really bother you, but you can take some of those dividends and buy it back low. And this is another form of diversification. We talk about diversification all the time, but here is actually one of the forms of diversification that we're using, and that really does some amazing things for a retirement portfolio.
Uncorrelated diversification, buying low, selling high to buy low again, and compounding money the old fashioned way through dividends and compound interest. beautiful thing to be able to help somebody's portfolio. That's what gold affords. Now, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, does gold belong in your retirement portfolio? We're given different reasons why we think it can, and we're not making recommendations, but looking at that. But we have a paper really like to give you to be able to help you understand this a little bit more and what the importance of gold could add to your financial defense. It could add to your offense, but it can also add to the defense. And defense is a very important part of what happens. Financial Defense is the paper. Ask for it by name by calling 800-725-7616, 800-725-7616. Also, if you have any questions or comments that you want to make regarding this, please offer those when you call 800-725-7616, or email us at office@agemy.com, or check us out on our web at agemy.com. Daniel, we just have a few more minutes left in the show today. Does gold belong in your retirement portfolio? I mean, you're clearly saying that when they're a true income professional, a true portfolio manager, a certified portfolio manager, can help be able to put together a plan that's going to be able to help people get where they need to be, have more than enough income to live the rest of their life. Gold can play a significant factor in that, and maybe people have it, maybe they don't. But this is one of the keys of many to put together a proper portfolio, right?
Yeah, absolutely. And there's two major risks. There's many risks, but there's two major risks that we're always thinking about when we're thinking about our client's portfolio. One is protection of principal, but the other is protection against policy errors. And I use that widely, but that would be things like massive money printing, where equities or gold or things just go to the sky because it's not really going up, but the thing you're measuring, it goes down. Now, this is not a likely event, but you have to be thinking about these kinds of things. And that's what true diversification is about. Diversification isn't owning a bunch of stuff. Right? Diversification means that you always have something that's non-correlated with markets or whatever the majority of your money is. So it gives you optionality. And we talk about income all the time. Income is really good at protecting you from volatility, from market risk, right? Bonds and bond-like instruments, because they have contracts backing them up. But what sometimes people worry about with that is they won't have enough upside if markets go and do ridiculous numbers. And that's something that investors need to be aware of. And diversification is something that can really benefit them. An example would be, you're always looking at risk return metrics. How much can I lose? How much can I earn?
Right.
And one reason why you and I talk about Bitcoin when it's still kind of a new thing to most people, and a lot of people don't understand it, is because the risk return metrics are insane. Where if we're wrong and it goes to zero, and you had 3% of your portfolio, your income of your portfolio covered that.
Right.
It doesn't really affect you. 3%. And that's if it completely went to zero.
That's worse. Yeah. Worst case.
And if it does what we think and it does 10 times, now all of a sudden that just became 30% of your portfolio. That is real money. That's actually life-changing money. If you have a position in your portfolio that did 10x, right?
Right.
That risk return is an amazing thing, and that's the diversification. Now, you don't have to choose Bitcoin. We went through how gold works, and this is determined on each person's understanding of the asset, each person's risk tolerance, all these kinds of things. We can help people navigate with their emotions what works best for them.
Right.
But, these are kind of three ways people can kind of protect themselves in different scenarios or add to complement, right? It's like a
Yeah.
turbo on a diesel engine. Your diesel engine is the income portfolio that's just always going. It can pull anything.
Right.
It can handle
Right.
anything. You put a turbo on there, and that's kind of what these royalty and streaming companies are. And the things that it can do for you with that turbo are just beautiful.
Sounds pretty exciting and effective. And that's what we find for it to be, just like the examples that we've been given. Nice, Daniel. Nice. Well, been listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic has been, does gold belong in your retirement portfolio? Well, we believe an educated consumer and an educated retiree is a happy and stress-free retiree. And we want to educate you further because people don't know what people don't know. So we'd love to put this book in your hand, The Richest Man in Babylon. It's a fun read, good read, give you some principles to be able to understand the purpose of investing properly and having the right people to be able to help you invest properly. And, because a stress-free retirement is what we're looking to be able to give people, be able to live at peace in retirement. So this book is for free. The next 5 callers at 800-725-7616, 800-726-16, 725-7616. And we love to put this in your hand. Call now. And we look forward to an educated retiree is a happy and stress-free retiree.